So, with inconsistent consumer spending for the Yeti brand, 2023 was pretty much a challenging year for the company. They still see continued market interest in their portfolio, even though they do anticipate some of these headwinds will persist until 2024. They do currently have a number of actions in play to drive demand, including a new range of products. Currently going for a $3.3 billion valuation, selling for around $38. They have been in that range for about a year and a half now. So if we take a look at the chart, it looks like the bottom was around $29. Anyways, today we'll talk about YETI Holdings. We'll go over some of the fundamentals. We'll take a look at the balance sheets. And we'll talk about some of the new plans that they have for the 2024 year. This is my sheet right here. Basically, it's going to show you the yearly data, and I just imported it from Seeking Alpha. Some of the things we're going to talk about: total revenue, earnings per share, ROCE, the return on capital employed. These are just some of the important metrics to look after while you're researching companies to sort of see if they are giving back to their shareholders. And we'll talk about each one in detail. When you take a look at revenue, so there is a slowdown in their sales growth year over year. Their biggest increase was in 2021 with a 29% increase year over year. They are slowly losing that growth phase in their total revenue growth. 2022 up only 13% and up only about 4% from 2022 to 2023 year over year. So right off the bat, we could see that there is a slowdown in their growth, but is this business still a good investment? We take a look at earnings per share. We could see that there's a consistent trend of positive earnings per share. When we take the average of the past 5 years, we could see that we get 1.56 in earnings per share, and pretty much they are averaging around that number. For earnings per share, you do want this number to be consistently around the average with a historical uptrend. There might be some down years, but you just want to see if it's consistent around the average earnings per share number. So what can YETI do to improve their revenue, and why I think this stock is an undervalued company? One of the main reasons is they have a strong balance sheet. So I've highlighted the cash amount right here with the long-term debt right under. They have huge cash holdings, around $440 million, with only $75 million in debt. So according to management in the latest earnings call, they are going to start putting their balance sheet to work. In addition to some of the investments they've been making to the business, they also announced an acquisition of 2 new product portfolios, which are going to be cookware and bags. One of the acquisitions they just purchased is Butterpat Products. So currently they are going to be developing a new line of cast iron cookware and accessories for the kitchen. This new growth category is going to come out this summer, giving them access to a $10 billion plus premium cookware market. So this is a good addition to their portfolio. YETI has also recently purchased Mystery Ranch. Basically, this is a Montana-based designer. They manufacture highly durable backpacks and bags. As you can see here, hunting bags, outdoor bags, fire bags, military bags, etc., etc. So again, this acquisition is going to expand their product line, giving them more access to a bigger market and hopefully increasing the revenue. And they're able to do all these purchases and acquisitions because they do have a lot of cash in hand with pretty much no debt. And lastly, why I think this company is undervalued. They just announced 2 months ago in February, the board of directors recently just authorized the repurchase of up to $300 million in YETI stock. So a lot of catalysts happening with YETI right now. Again, the company is doing a share buyback, the recent purchase of Mystery Ranch, and also expanding into the new category of cookware. Just some other quick facts on the growth of YETI. It does look like their international business is having a better year in 2023, growing 28% year over year. The country where they're having the biggest growth is in Europe. Australia and Canada have both been good regions for growth as well for YETI. Okay, so just real quick, a metric I want to talk about, I have it right here highlighted, ROCE, return on capital employed. So what is return on capital employed? Pretty much it's a financial ratio that measures the profitability and efficiency with which a company utilizes its capital. And we'll start a little notes section right here, and we'll just put why is return on capital employed important. We'll give the top reasons on why we should watch this metric while you're analyzing companies. So the first one, of course, is going to be the efficiency indicator. It's going to show us how well the company is generating profits, like I said earlier, from its capital that they have. This is crucial for companies with significant investments. Next, we could use this metric to compare to other companies in the same industries. Next is the performance measurement. You want to ask yourself, how is management using the company's capital? We want to compare year over year how they are improving. And lastly, trend analysis. Pretty much we could use this over time and we could reveal the trends in the company's operational efficiency. I'll probably end up making a longer video to go more into detail into return on capital employed. And also we'll go into the next one, return on total capital. But as you can see right now, when we take the average of YETI's return on capital employed for the past 5 years, we're going to get 38 percentage range. This is just a good metric to watch, and you always want to compare it to earnings per share also. So you want consistent earnings per share, usually with a historical uptrend, and you would also want return on capital employed that's consistent with a historical uptrend. They are getting returns on their capital efficiently. I believe they're going to return it back to their shareholders. I think this is a good sign that they are going to start using their balance sheets, and they do have a lot of extra cash. To sum it all up, with Yeti's capital light model, they have a clean balance sheet, strong cash flows, factored in with some of the new acquisitions that they just purchased, international growth, with the acquisition of Mystery Ranch and Butterpat Industries. These will all provide unique opportunities to accelerate product innovation. For the past year and a half, they've been hovering around the $30 range. I believe they have a lot of opportunity ahead to put capital to work in support of their value creation and their growth agenda. Let me know what you guys think. I am on the side of it being a little bit undervalued right now at a $3 billion valuation. So let me know what you guys think. Thanks for watching. Don't forget to follow.